Buckle up, everybody. The stock market looks like it's on the verge of a very, very bumpy ride. You're watching the Daily Stock Market Brief. My name is Michael. This is my pup, Coco. She knows everything and teaches me everything. Today's date is November 20th. I do these videos Monday through Friday. I have so much to talk about, so many charts to go over. So today's video, being that it's a week close, it was OPEX week, it's going to be a little bit longer. But if you only want to listen to certain sections of the video, I got you. We have timestamps in the description and probably in the comment section as well. Today we're going to be talking about indices. We're going to be going over the four big ones. We're going to be going over some indicators, commodities. We're going to go over the dollar yields. And then I'm going to be breaking down a conclusion, which I even have additional charts there. Let's just hop right into it. All right, first thing is first, we're going to go ahead and talk about the indices, starting with the S&P 500. Now, keep in mind, why am I saying that this stock market looks like it's in for a very bumpy ride, potentially a correction in the very near future? Well, let's start with basically breaking down higher and just macro type view context on these charts. So in order to do that, we're going to be looking at multiple time frames, starting with the monthly time frame. First, I just want to point out where we are on the chart right now. Looks very bullish, right? We're just running up these last couple of months. Each one of these candles represents a month of data. And where are we right now? Well, we're at the upper end of the Bollinger Band on the monthly time frame, very disconnected from the 5 EMA. This is a very aggressive move, and sometimes when we see these rubber band moves into overextended territory, it's likely to see retracements. All right, so that's the monthly time frame. Where are we on the weekly time frame? Well, on the weekly time frame, I pointed this megaphone pattern out quite some time ago. Many people have. It's not revolutionary by any means. But then we also added this red trend line that's dashed. And as you can see, it's shorter term from 2018. We resistance, resistance, resistance. And now we're at the upper end, like I said, of this Bollinger Band. And we hit this resistance. We have a negative divergence in both the RSI and the MACD. All right? What's a negative divergence? Well, I guess I can't really go into the whole details of that, or the video would run too long, but just know that negative divergence, how I look at them, when they get really overextended to the upside and you have basically a high here and then a higher high here, but in the RSI oscillator we have a high here and a lower high, that right there is a negative divergence. Now, on the daily time frame, what do we got going on? Okay, first off, the bears have control of the 5 EMA closing into the week. All right? But, and that comes with a big but, I wouldn't really necessarily say that the bears are in control by any means right here. Where would be a better level to know that the bears would be more in control? Well, I think that we need to get below this upper trend line of this symmetrical pattern to make sure that was actually a false breakout. I mean, it was a real breakout, but the breakout could not survive during the current economic conditions. So we broke out to the upside. Now we're heading back down just slightly. We have right here a bull pennant on the inverted VIX. So if we start breaking out to the upside, that can definitely shoot us higher. We're by no means overextended on the daily time frame, but on the monthly and the weekly, we are. Okay. Now, if we start getting a gap down, that'd be quite interesting. This could be somewhat of a, I mean, people can call this, I can see the argument for the possibility of a, what do we call this? An island reversal pattern. Why could it be that? Well, we got above this symmetrical triangle line. We basically broke out above it by gapping clear above it. So this could be forming, especially on the weekly time frame, a start of a island reversal type pattern. So we got to be careful there. And this very aggressive move with all the gaps to the upside, it just needs to take a breath. And that's very normal to see. Okay, now I want to point out something very interesting here on the daily time frame, and then I'll even bring up a larger time frame. But really, what are these horizontal and this vertical line right now marking down to this territory? Well, what I just want to point out on the S&P 500 that I find very interesting, that I haven't really seen too many analysts or technical chartists, whatever you want to call us, mark this out. So this right here is actually the start of 2020. All right, this is where the year started, and just look at how many times this level acted as support and resistance. We won, right? We started off the year good, but then we pulled back right into the start of the year. Then we pulled up, and this was the crash. But how did we get down to this crash? Well, we had to pretty much just gap down through the entire level to really make an impact. Now what do we got going on? Well, we got this right here in June where we had this really, really sharp move to the upside, creating a lot of gaps, and then we found resistance right at that level. Now this is interesting, okay? When we finally broke through, we started squeezing higher significantly, got overextended, and then we pulled back where? Well, we pulled back to the start of the year. Then we bounced from that level. We fell back again, right? Got overextended to the downside of the Bollinger Band, retouched into the year, and now we're starting to see a higher move once again. This move right here with all these, just this straight vertical movement looks very similar to right here, and it looks very similar to right here from May to June. All right, so something to just keep in mind when we had those vertical movements with all the gap ups, boom, right there, we've seen retracements, all right? It's not to say that it will happen, but if we start closing below the symmetrical triangle, you know, buckle up. Like I said, it could be a very, very bumpy ride. And now I don't have a chart on me for 2001 or even the 2008 financial crisis, but what you typically see when we saw those crises, sharp moves to the downside, but then we saw big moves to make even all-time highs, and then we saw moves to the downside, and then we saw move to almost make an all-time high. It was just back and forth craziness. What's this? This is the yearly time frame. This is the SPY. Why am I showing you this? Well, I just wanted to show you that, okay, the year opened up here. We came all the way down. We moved all the way up. This right here is a hanging man candle. Who looks at the yearly time frame? I don't know, but it's data, and I like looking at data. So let's not ignore data. A hanging man candle is sometimes a reversal type candle. Does that mean it's going to come all the way down here to 150? No, that's not what it means. That's not what I'm trying to say. But what I am trying to say and what I'm trying to point out is where the year opened, there was a lot of support, a lot of resistance within that area, and we're forming this kind of, you know, could very well be a doji candle by the end of the year. Or it could just be a completely shaved head shaved head hammer candle, which is known to be a reversal type candle. Let's look at the Nasdaq 100. Nasdaq 100, negative divergence on the monthly time frame. Once again, I want you to pay attention to just a couple of things. We're extended the price actions above the 5 EMA by quite a bit. And at the upper range of the Bollinger Band, we reached up there and we got a little bit slightly rejected. And also that was at a previous, right around an all-time market high there too as well. The bulls are technically here in control. In order to see something change, we really need to get below 11,000 because that seems to have a lot of price history those last 4 months right in that zone, okay? On the weekly time frame, the false breakout right here. So now there's a hanging man candle right on the weekly time frame. Big move to the upside, hanging man candle. We didn't get any follow through or any movement this week, right? Down 0.26%, basically flat, but we're below the symmetrical triangle trend line and we're above the 5 EMA. What's going to happen here? Well, we will see next week, like we've stated previously, OPEX week, you see just a bunch of back and forth chop. That's what I mean by chop, and that's what I mean by like not doing too much movement. That's kind of why I just stayed personally outside of the markets. What do we need to see happen for the bulls? We need to see it break above and hold that level. But keep in mind, the Bollinger Bands here are contracting. We're at the higher end range of that. Maybe if we break out, it could potentially be another false breakout like we saw right here. We need to be very, very careful with our long positions here. Here's the daily time frame. You can kind of see more clearly that just for the last 3 or 4 or 5 trading days, we've just been going sideways. Okay, that was this week. Not much movement on the daily. We're below the 5 EMA, so bears have that. We have a little bit of gap below us. So yeah, not much data. We're just struggling very hard to stay above this upper trend line. So we keep getting rejected. Maybe it's basing out for a potential move to the upside. What gives me not the greatest confidence of that, at least for right now, is the fact that we had resistance here. We gapped above that resistance and quickly got rejected. And it kind of looks like this big sharp move to the downside is kind of rounding out to potentially head lower to fill a gap. It's not for certain, but that's kind of just what I see. Let's look at the Dow Jones. Dow Jones on the monthly time frame. Where do we tag? Okay, we tag the upper Bollinger Band. Okay, boom, you tag that. Hey, if you got in short right there, congratulations. That was a perfect move, and now you're down, significantly from that point. Up already 10% for the month, almost 11%. Extended from the 5 EMA quite significantly. So if we were to close up here and start a new monthly candle, just keep in mind how extended that move would be, and we're at the upper range of the Bollinger Bands. All right. Once again, we have negative divergence on the RSI. Obviously, a lot longer time frame when you're looking at the monthly. On the Weekly time frame, what do we got going on? This is very interesting, okay? I said pay attention closely to this candle for the week. Why? Well, first off, we had this gap up from the week. Oh, cleared over extended from the 5 EMA at the upper range of the Bollinger Bands. We gapped higher this week than the previous week. We went higher than that week, and then we closed below the low of last week's trading. The open of last week's trade, not the low. The low was down here. But what was interesting about the previous week is we couldn't make it above and close above the February all-time high. So we could not close there. And then we came down and retested this lower portion of the trend line, so it held up. This right here does, to me, look like it could be forming an island reversal type pattern. Can we get a gap down on Monday? I don't know. I mean, it's very possible. But keep in mind also, we might find support at the 5 EMA. If the bears start taking control of that on the weekly time frame, watch out. Like I said, it can be a bumpy ride. Here it is on the daily time frame. Bulls not in control here. I mean, technically, from the big thrust of the upside, you can go back and forth. I'm just saying in context of the 5 EMA, the bears have control at this particular point in time. Look at these are some big gaps and big vertical movement to the upside. Then we just get back and forth chop like the market doesn't know what to do. Have a negative divergence on the RSI. The MACD looks like it's starting to cross over and curl over, which can put more pressure to the downside. In order to really gain control here for the bears, we need to cross below this upper trend line of this channel. Until we do that, bulls are still technically in the control of this kind of market as we speak. Like I said, if we start moving below this, closing some gaps, or get some, even a big gap down on Monday, this can really start us off for just a very bumpy ride. Okay, Dow Jones here, same on the daily time frame. I just wanted to point out once again, boom, let's target into where this year started, where we went up, kind of found support in that area, and then we gapped through that level. Okay, we came up here in September, rejected. We had to gap above, okay? So we couldn't go test it normally. We had to literally gap just this monster from like basically 28.5 to 29,000 almost. Maybe, no, even higher than that. Almost 29,500, just a huge gap up, okay? Got overextended, and then we're seeing this kind of, I wouldn't even call that consolidation because it's just so choppy right there. The negative divergence on the RSI. What's this look like right here? Okay, this looks like an island reversal pattern on a big thrust to the upside. What's this look like right here? A big thrust to the upside and an island reversal pattern. Put two and two together. I mean, history doesn't always repeat itself, but sometimes it rhymes, right? Let's look at the Russell 2000. Monthly time frame looks pretty strong. We broke out above this. It looked like a triple top, but now we're moving higher up above. Now, we still have time in this month, but also take a note where the price action lies on the current chart. It's above the upper Bollinger Band. This, to me, looks like a good shorting opportunity, despite it breaking out from this all-time high. Now, call me crazy, but there's a negative divergence, there's a negative MACD. Yeah, you have the case where, no, this is an excellent breakout. Month ain't over yet, though, okay? It very well closed above there, it could close above there, but I just want to point out just a huge move to the upside. Some might say that's an overextended move, and like a rubber band, right? Rubber bands, they can get stretched out, but when they get too stretched, what do? They contract. Weekly time frame for the IWM. This looks like an island reversal type blow off top, okay? We didn't test the upper portion of this rising wedge or really even the all-time market high. What did we do? We had to gap clear over it after hours. Where are we standing right now on the IWM or the Russell 2000? We're above the Bollinger Bands. We are super disconnected. That's crazy. So it just goes to my narrative of saying like, yeah, this looks like a slam dunk short opportunity personally. Now, can the market go incredibly higher? Yeah, the market can go incredibly higher. It's very hard to time market tops and market bottoms. But looking at this overextension on the Bollinger Bands, I wish it was overextended on the RSI right here as well, but it's not on the weekly time frame. It's darn near about there, and it doesn't get there often, okay? But, it's just, something to take note of. It was basically overextended right around this area too, and that was right before the March fall off. So, yeah, what do you know? Let's look at the daily time frame, IWM. It doesn't look too bad right here. We didn't close above for the week, or for the day, I should say, above this resistance line. The RSI is darn near overbought. And every time that it does get into this overbought territory, we see pullbacks. So bulls have control, in theory here, I would say. They have the 5 EMA. We're on the upper range of the Bollinger Bands, and we're right below this resistance. Hey, maybe we get a gap above, and then we collapse down. That would be killer for a shorting opportunity. We have a negative divergence here on the stochastics as well. Let's look at some indicators to help guide our thought process. We were looking at some on those charts, but now let's get a little bit more in depth on some indicators that I like to look at around breadth and sentiment, starting with the VIX. Here is the VIX. This is the volatility index for the S&P 500. And what do we got going on? First off, we have a huge gap down here. Hasn't been filled. But what I also want to point out, other than that's been bugging me, is when the VIX vol came down to 2250, this range, it usually gets pretty punchy to the upside. And when things get punchy to the upside, well, what has happened to the S&P 500? With the S&P 500, it drops. We have a falling wedge right here, looking like it might want to break out. And we have support holding. It held here. It's holding so far here. And right here, you see where we gapped from this level up over this same exact area. So a lot of history here from the support level looking back till the mid of February, up going into March. Okay, so something to take note of here. The pattern, the support, the gap below us, things could get punchy. What did I say a couple market briefs ago? I was kind of expecting us to punch around 2750 here in the near future. Maybe we might go higher. Maybe we might break down. It's very hard to say, but let's look at a couple other indicators. Quite a few other indicators. This is the CPC smoothed over the 10-period moving average. I've been really liking this indicator because it helps out to really find sell signals. What do I mean? Cross below, that's the warning. When it crosses the moving average crosses below the red line, warning. Crosses above, that's a sell signal. Look at same thing with the green. If it crosses above, hey, we might be able to buy. When it crosses below, that's the buy signal. The buy signal worked out quite well, which I don't really use this too often as a buy signal, just so you know, just to clarify. But the sell signal makes a lot of sense to me. Now the price action is just, the CPC 10-period moving average price action, I don't know what you want to call it, is streaming down very close to moving down below 80. That's going to be the warning when it crosses above. Hey, that is the quote-unquote sell signal, which means, hey, make sure you're taking profits. Make sure you have your stops in place. If you know some advanced strategies, or if you know how to short, and if you know how to control, doing that, by all means, you can do that. So I'm kind of all narrowing it back as to why this is going to be a very bumpy ride for the indices and for the stock market. And kind of, like I said, in the conclusion area, I'll probably talk a little bit more, but the Russell 2000 being how overextended it is, and we're seeing the CPC come into this sell signal potential right here, just things are lining up like gold right now. Next indicator is the NI high-low. This is the high-low index. Like, I'm not going to explain every single thing about what it is and what it does. You can just Google it. Maybe I'll make videos separately sometime, but what I want to point out is where we're standing right now. It's at 92.96. This is a very laggy indicator, okay? What I want to call out is just the fact of the velocity of the move to the upside and the overextension to the upside. And then there's a couple times where this happened, moved up to those levels on some strong velocity, and you saw pullbacks, you saw pullbacks, you saw pullbacks. This was a strong move in the price action. Maybe we might see a pullback, okay? Something to note. This is the percentage of stocks above the 200-period moving average and the 50-period moving average in the S&P 500. When they both get so red hot like this from a thrust to the upside, things are saying to me that, hey, things are a little extended right now. Probably needs to take a breath, cool off, and consolidate, and or you might see just some more of a correction or pullback in various stocks. Now, what does the 87% mean on the 200? Well, 87% of the stocks in the S&P 500 are above the 200-period moving average, and the same goes 79 for the 50. They both crossed over 80. Last time that they both crossed over 80 at the same time, we saw a pullback, 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 and a pullback. Obviously, this data is only going back to 2016, so you got to take it with a grain of salt, and we just got to line it up with everything else. What is everything else telling us? Here is the AAII surveys, okay? What do we got going on here? Well, last week, everyone was super bullish. to the point where you'll look back over here in 2018 when everyone was super bullish. We started getting some very, very, turbulent times starting in the market where it's our pullback. It's been crazy. So we're getting at those levels again, both on the bulls to bears ratio. So we need to just pay attention to where the sentiment of the market is. The sentiment of the market is saying, hey, we're all way too bullish. So maybe all the bullish trades have been placed and we should start looking from a more bearish perspective. Okay? Robert Kiyosaki says, coin has three sides, heads, tails, and the edge. The stock market should have three sides. You have heads, the bulls, tails, the bears, and then you have the edge, the wolf. Okay? The wolf looks and pays attention to both sides of the coin. It's not that we have to pick a side and stick with it all time, which for some reason a lot of people believe that that's the case. No, you just got to read the charts. What do the charts say? What does breadth say? Well, we're going to go into breadth right now. This is the McClellan oscillator. McClellan oscillator, double top on the oscillator, and we're seeing breadth starting to take a little bit of a breather, okay? 31.27, that's less than the previous day and less than the previous day on top of that. It looks similar to 2018, a little bit different, but if we start taking a very steep breath to the downside, buckle up because we might very well see that market pull back. If we start breaking below those levels, the 3,200 I should say, it could get very bumpy. I'd start looking at 3,000 to 3,100 as that target zone. But now, honestly, my target zone is really ranging from 3,250 probably all the way down to 3,000 just because of the fact I don't think that anyone's going to be letting the market really collapse all too much, because it would just be complete devastation at that particular point in time, especially with, just open your eyes and just go to the grocery store. Everyone's on edge. Everyone is on edge right now. So yeah, the stock market's making all-time highs. How come no one's happy? It's very hard to find happy people. Every once in a while, yeah, you get this big burst of everyone around you is happy, but lately, oh my gosh, people are driving, and maybe it's just California. Maybe it's just Californians. I have a very obviously small viewpoint from my own personal experience because I'm just one person in a very small, little tiny, city basically. And Californians drive like crazy. They're so aggressive. Let's go into commodities because I'm starting to rant on. Bear flag and gold. This doesn't look good to me. Okay? It doesn't. I would love to see it start breaking out and capture the 50, but I'd love to see it break down to 1850 and start moving back into my buy territory. The price action is remaining above the 200 period moving average, and every day that happens, the 200 period moving average moves higher and higher. All right, so gold could be very well setting itself up for a very good possibility, but keep in mind what happened in March when equities really took a nosedive and there was a lot of fear out there. Hey, gold went down with it. However, gold recovered pretty darn quickly. I mean, equities did too, but some of those miners went up 300, 400, 500%. It was crazy. Silver, inverse head and shoulders, descending triangle. Also, it's kind of holding that support area around 24 bucks. It's getting rejected. It's hard to close above the 50 period moving average. It's one of these pause games. We got to wait. We got to wait for an extension to the downside, 200 period moving average or even down here, or we got to wait for a breakout. You just got to be patient here. Bitcoin, the shining star. Bitcoin continues to this is parabolic, just so you know. Just so we're all clear, this is a parabolic move. I've been saying it's a parabolic move probably from right around here. We're going to get into the daily time frame just so I can show you where this stands. RSI, how high can this go? It's so high right now. Look at it. It really looks like the market wants to go tap into that 20,000. The unfortunate thing is when you get a move so vertical and parabolic and it comes into an all-time market high like that, you're going to see retracements. You're going to see volatility really pick up. You're going to see just very, very bumpy action. So buckle up. Look for areas of support. If you're a Bitcoin guy, Bitcoin gal, if you really think that this is going to go 100,000, 200,000, the new currency, whatever the case is, like I said, I don't really understand it, but from a charting perspective, I can tell you what I see. A pullback to about 14,000 would actually make sense to me. Okay, we had resistance right there around 13, 14, and then we had a resistance right here. This is a parabolic move. It's likely to see 50% retracements from breakouts and parabolic moves. So keep that in mind. Here's the daily time frame for Bitcoin. Still within the channel. Slightly a divergence in the RSI. You can say that this is almost horizontal, but it is technically, I looked, divergence. Okay. big just bull channel to the upside. Maybe we just come back down and just keep retapping and touching into this channel. That means if it does get a little bit rejected here, we might see it pull back to about 17.5. If we start breaking down from the channel, then that's when I say we can start breaking down to about 14,000, which is right around the 50 period moving average. Look at the dollar. Dollar's not telling us much right now, but somebody posted on Twitter, do you think it's this basing pattern is a diving board or a launch pad? To me, it looks like the dollar, I said, was walking the plank. I mean, it's at the lower end of this channel. It looks like this big pull here and then kind of a dead cat bounce. It's still holding up above 92. 92 is a very important technical level here. If we start breaking and closing below that, I think that the dollar has more room to go down. On another market brief on a larger time frame, I think it said around 87. I don't know if that's going to happen, for certain, but right now, where it stands from a technical perspective, it looks like it wants to break down. Will it? I don't know. I don't know. If support holds, and this is the way you can think about it. If it breaks above 95, that's bullish. If it breaks below 92, that's very bearish. But overall context of this, keep in mind, price action is below the moving averages, 20, 50, and the 200. They're sloping down. The context is bearish. You can't change that. The only way you can change the context from bearish to bullish is by setting up bullish trades in the dollar. And right now, that is not a bullish trade. That is a bearish trade in bearish context. Read the chart for what it is and then continue on. Until something changes, my view would change. I'm just reading the chart, like I said, for what it is. Yields. Now, you might call me a little crazy on this one. I don't know who charts spreads, especially with technical patterns. Maybe I'm the only one. Maybe I'm not. I don't know. Maybe I'm genius for just doing this before, even the smartest analyst out there do it. But, what I know is I know technical. I can read charts. And I know when things, I understand the psychology of patterns, but that's about it, okay? When it comes to like really understanding macroeconomics, it's very difficult to really just learn all of that stuff. There's so much of it. But what's so powerful about the bond market is they take in all that macroeconomic data, all that economic data, and then they put it into the bond market. So you can just look at a chart and really they're pricing in all the data that comes out. It's a beautiful thing. Okay, so what do we got going on here? Well, these are yields, and I changed up the yields a little bit, okay? I had a 3-month on here, but I changed the 3-month to a 5-year. The green line is a 5-year, all right? What I want to point out here is the 30-year just broke a trend line to the downside. Does that mean anything? Maybe, but maybe not. I will say that the trend line's been holding up as support since August. So that means something, right? Maybe. Now we started to break down through it. So bonds, maybe, maybe this is a risk-off type move. Perhaps. Actually, what's very interesting is last week, or this week, I should say, coming to the close, utilities did the worst, but Friday, today, utilities did the best. Interesting. So maybe that's an early sign of what we're about to see coming up. Why am I saying that it's going to be a bumpy ride? Put it all together, folks. Put it all together. This right here are the yield curves. The 10-2 is a very popular one to be tracked. When it goes below 0, that's an inverted curve. When it goes up, that means it's steepening. This is just, the bond talk jargon. When it starts heading down, that means that the yield curve is flattening or the spread is narrowing, okay? So we're running into this trend line. Maybe we might start breaking it down. But we're still here holding support. What I want to show you is the 30-year minus the 5-year. I find this to be kind of interesting and why you might think I'm a little weird or crazy for even bringing it up maybe. But notice the pattern. It's a rising wedge. Rising wedges are bearish patterns, and we just broke down through it. What's this red line mean? Well, the red line is an estimate of how far a breakdown can be on a, now this is just a rule of thumb that I use, of how far a breakdown could be of a rising wedge. You really just take the base where it started to the upper part of the base. So I just measured from here to there, brought it out with the vertical line. We broke down right at this level. So that means that the yield curve, the 30-5, start heading down here. It's going to be narrowing quite a bit down to about 0.65 to 0.7-ish, right around in that range. What does that mean when we have a flattening curve like that? Well, they're not pricing in growth. They're pricing in a potential economic slowdown is what that means, okay? When it starts going up, when the spread increases, the market is pricing in future inflation, future growth, And when it starts tightening like this, or potentially even inverted when it gets inverted, and I look back in the history of this 30 minus 5, I didn't really see it inverted. I'd have to go probably back even further. But when it starts really going down at a rapid level, you know, things get a little out of control. So something to take note of. Let's get into the conclusion of everything. All right, so yeah, my conclusion is this. It looks like the market it's overextended, it's overheated. That doesn't make me a bear, okay? You can call me a bear, I don't really care. Or a bull or a wolf or whatever you want to call me. But from a technical perspective, things are very overextended. Things are overheated. Things look like they need to take a breath. Things are struggling to break through these new levels of resistance. Even on these 15-minute time frames that I want to kind of go over right now, and I've been pointing this out before even these days occurred, we have head and shoulders right here and a symmetrical triangle. It might want to start breaking down from these levels. Doesn't mean it's going to, but it does, you know, it's something to note. It's not looking the greatest right here. Okay, this is the double-headed dragon pattern. You have the left shoulder, the head, and they're both connecting right here, okay? The right shoulder and the left shoulder meet. Be very careful with that pattern. The Dow Jones, same thing. These are smaller time frames. Head and shoulders. Rising wedge on the Russell 2000. This is the 30-minute time frame, and a head and shoulders. It actually broke down through this line, and then it came back to back test it, and now it's kind of struggling right around that area. And like I've been saying, the Russell 2000 really honestly looks, it looks like the best opportunity to short it. So, you know, call me crazy, call me whatever, but it does. It looks like a great opportunity. The transports of the Dow Jones, this is important, okay? The transport industry makes up a big portion of the Dow Jones index. And we have an inverted, sorry, not an inverted, I'm getting my words all mixed up, a bearish divergence. Have I been saying bullish divergence? I always get them mixed up. God, I always do that. Bearish divergence and a rising wedge, very steep looking rising wedge. We saw the same thing back here, boom, down to the downside. This looks like it wants to start breaking down. We have a negative divergence there on the MACD as well. Then the semis, also a big portion of the Nasdaq. Negative divergence, or bearish divergence, whatever you want to call it. You know, it's just everything is pointing to the downside. Everything is pointing overextended. I really want to see a bull's perspective and why you should go super long right now, but just from a technical perspective, it doesn't make sense. So then you might come in over the top and say, well, they're going to just print more and more money. Everything's going to be fine. Or is it? Because what just happened with Treasury Munchkin and Jerome Powell, right? They basically cut off, you know, December 31st or whatever the date is and the other portions of their emergency funds. Now, there's a big clause there, and there's a lot of reasoning behind it and all that good stuff, and I'm not going to get into that. One, probably because I'm not the greatest source of news for it. But, yeah, the markets took that as a lot of turbulence, and then, what do you know, the very next morning, Nancy Pelosi's out and Treasury Secretary's out, and they're both talking about, you know, all kinds of stuff to basically provide more optimism to the markets. Hey, we should be fine. And don't worry because we have plenty of ammo. We have the tools if things were to get sour. And you know why they say that is because things will probably get sour. It just seems that way, and we seem overheated. You know, call me pessimistic, call me cynical. I don't really know, man. I don't really know. But what I can say is I'm not in the market right now, and I'm okay with that. Even if we rip up another 1,000 points, I don't care because I know that fast moves like this always result into some bumpy rides. All right, everybody, that's all I have for you on today's weekly end close of the Daily Stock Market Brief. I really appreciate everyone coming out and watching this channel. I'll see you later.